Are we finally seeing the light at the end of the tunnel concerning the big Canadian telecom companies? Well, to say the least, the latest earnings report of Telus that just came out were a big positive surprise for many investors. It is why today we'll take a look at what have been these more recent earnings report and what they mean for the future valuation of this company. And at the end of the video, we'll take a look at what is the current intrinsic value of Telus with different valuation models to determine whether or not it is a great stock to buy at the moment. But first, before we take a look at the financial performance of Telus over their latest earnings report, we need to understand how they've been able to generate their income and how they've been able to perform over the past couple of years. Telus is currently amongst the three largest Canadian telecom companies alongside Bell and Rogers that all worth close to 90% of the total telecom market. So it is fair to say that at the moment, this telecom market in the country is currently divided in a triopoly. Nevertheless, over the past 2 years and a half, we've seen that these big Canadian telecom companies have all been plummeting in terms of their total valuation while the market on its side has been surging. Well, the main reason is that these telecom companies have been facing stricter rules by the regulatory agency in Canada that is regulating the telecom market, which is called the CRTC. In fact, to increase choice and affordability in high-speed internet services to more than 5 million Canadian households, the CRTC has decided to impose a price limit to all the Canadian telecom companies on the products and the services that they are offering to their customers. This has been harshly hitting mainly these big Canadian telecom companies such as Bell and Telus that have been proceeding to massive layoffs over the past year and a half. In fact, these companies are not only selling their classical products such as phone, internet, and television services, but they are also selling their 5G network where they are massively investing to expand it all across the country. Add to this, these types of companies are not growth stocks such as Meta or Tesla that are way more shiny than them, but they are more considered as some blue chip companies that are offering gigantic dividends, where in the case of Telus, we can see that their quarterly dividend is currently with a dividend yield exceeding 7.5%. So all of these financial expenditures obviously represent a certain financial burden to these businesses, meaning that they obviously need to finance their activities a lot with debt, where we can notice that Telus on its side currently has a debt to equity ratio exceeding 170%. This means that by forcing a price limit to all telecom companies in Canada, the CRTC has made these big telecom companies stop investing as much as they did in the past in expanding their 5G network, for example, because at the end of the day, this company has a lot of debt, meaning a lot of interest to pay, and at the same time, it also means that the company needs to keep a certain level of profitability to keep the money of the investors invest in them. So now that you understand what is the current situation of this big telecom company, let's take a look at their latest earnings report that were reported on the 13th of February 2025. So in terms of the earnings performance for the last quarter of 2024, we can notice that Telus has been able to outperform the analyst expectations for both the earnings per share and the total revenue, where for the total EPS, they were expected at 22 cents per share and they were reported at 25 cents per share, or an increase of close to 15%. And in terms of their revenue, they have reported some quarterly revenue of $5.38 billion compared to $5.24 billion that were expected, or an increase of about 2.76%. And when we take a look at the three past earnings from Telus over the past quarters, we've seen that they've been able to outperform the analyst expectations every single time. Now jumping out to the latest earnings report of Telus, we can first see the main important highlights that have been reported by the company over the past quarter. But what interests us the most is first the consolidated financial highlights. So the first thing we can notice within these highlights is the fact that their operating revenues and other income have been slightly increasing by about 3.5% year over year. And despite a slight increase of about 1.9% in their operating expenses, we can still see that Telus has been able to increase their total net income year over year by about 3.2%. Then in terms of the earnings before interest, tax, deduction, and amortization, which is pretty useful to calculate what will be our free cash flow, we can see that the company has been able to increase them by about $1.77 billion in the last quarter, or an increase of about 3.7% year over year. Then for the capital expenditures, as I mentioned earlier, their objective was to diminish them as much as possible over the past 2 years. But despite that, for the last quarter of 2024, we can still see that their capital expenditures have been slightly increasing by about 3.4% year over year. Nevertheless, one of the bad news of their earnings report was the cash provided by the operating activities that have been massively diminishing of about 18%, which obviously will have a certain impact on diminishing their total free cash flow by about 10.3%, as we'll see later on. Then in terms of their main business segment, which is the telecom subscriber connections, we can see that this segment has been massively increasing by about 5.9% in the last quarter. And another business segment that isn't known by many people is the fact that Telus also offers great well-being and healthcare services to their customers. And in that regard, we can see that Telus has been able to increase their healthcare lives covered in millions by about 9.6% year over year. After, what is interesting also to know about the earnings from any companies is what are the financial targets for the upcoming year. For Telus, for their 2025 targets, we can see that their operating revenues are forecast to be growing between 2 to 4%. Their adjusted EBITDA are expected to grow by between 3 to 5%. And then their free cash flow are expected to be at about $2.15 billion and their capital expenditures to be about $2.5 billion. In terms of their dividend declaration, we can see that they have decided to declare a quarterly dividend of about 40 cents per share. That will be payable on the 1st of April 2025, but with the next dividend date on the March 11th of 2025. And this is a pretty good news for the investors because this quarterly dividend is reflecting an increase of 7% from the 37 cents per share that was declared the year prior. But now to understand why their free cash flow have been quite significantly decreasing year over year in the latest earnings report of Telus, even if their total EBITDA over the past quarter has been slightly increasing compared to the same period in 2023, we can notice that the main reason behind it is the fact that first, their Telus Easy Payment mobile device, the financing has been increasing, so they have more debt on that side. And we can also see that the total interest that have been paid by the company has also been growing because obviously the company has a lot of debt, and with the high interest rate that we still have on the market, this obviously makes that it will pay more interest compared to a company that will have less debt. And finally, what is also interesting in the appendix is the fact that we have all the different business segments, the total operating revenues and other income that they have been generating. And the good news for the investors is that all of these business segments, except for the fixed voice services and the mobile network revenue, have all been growing year after year. Finally, to determine what is the true intrinsic value of Telus, as always, I'll be using different valuation models, starting out with the Peter Lynch one, which is a simple formula where you add the future growth of the earnings per share with the dividend yield and that you divide with the price to earnings ratio. And even if the company currently has a high dividend yield, the problem with it is the fact that they also have a high price to earnings ratio and they have a low EPS growth that is predicted for the next 5 years. All of these factors are making that it would currently be quite overvalued according to this model. For the second model, which is a dividend discounted model, unfortunately, we can see that this model won't work since our average growth rate is bigger than our weighted average cost of capital. But then for the third model, which is the discounted cash flow model, where we will simply discount all the future free cash flow that are predicted for this company in the future to see what is its current enterprise value. We first need to see what is the cost of debt, then we find the cost of equity, and after the cost of debt and equity to find our weighted average cost of capital. And then with the weighted average cost of capital, we can find what is our intrinsic value of about $13 per share, which means that in that case, this company would currently be quite overvalued right now. Finally, for the two last models, which are the Graham's original value formula and the Graham's revised value formula, we can also find that in both cases, the intrinsic value of Telus would currently be quite overvalued compared to its current price. So as you've been able to see, according to the different financial models, we can notice that Telus would currently be quite overvalued. At the moment, I personally believe that there are better places to invest your money because of all the restrictions that these types of companies are facing. Nevertheless, in the long term, with the multiple decrease of the interest rate by the BOC in 2024 and with the ones that are forecast for 2025, combined with the gigantic dividend that they are offering with the necessity of the business model of Telus, this business could definitely be able to turn around as we've been able to see the day following the earnings. But now on your side, if you're looking for other great alternatives instead of doing some stock picking in the Canadian market, you could decide to invest in some of the best Canadian ETFs for 2025. And so in that case, check out the video that's going to be right over here, and I will see you soon. Peace.